many people in this room either drive a car or ride a two-wheeler? Show of hands, please. Almost everyone. When you drive, 80 or 90% of the time, do you look in the front or do you look at the rear view window? Front, right? You don't look at only the rear view mirror and drive. Let's say if I told you that we will put a black film on the windshield and all you had to do is look at the rear view window and drive the car. Would you be comfortable driving that car? No, right? But that is what we do when it comes to investing, either in equities or in mutual funds. Whenever last 5-year returns or last 1-year returns in equities are good, a lot of money comes into mutual funds. People just rush into mutual funds. And whenever last 1 year or last 3-year returns are bad, people either stop putting in money or people redeem what they already have. So this is the biggest mistake that people make in equity investing or in mutual fund investing, or real estate for that matter, or Bitcoin or whatever. Whatever has gone up in the past, people want to own that. Whatever hasn't gone up in the past, people want to ignore. Whereas actually the reverse should be true. 1992 to 2003, 11 years equity prices went nowhere. In fact, they were negative. And 2003 to 2007 was among the biggest bull runs. Again, 2017, very great year for, let's say, small and mid caps. Everyone rushed into small and mid caps. But 2018 gave losses. So, drive your investments the same way you drive your vehicles. Yeah, so real estate, people talk about, there are only 3 things that matter in real estate: location, location and location. So real estate is all about micro markets. So one particular flat or office block may do very well, whereas one particular locality may be down in dumps for 10 years. So just like I gave an example of stocks, 2 different companies, one doing well, one not doing well, same would apply to real estate. So in real estate, generic answers absolutely do not. See, what happens is, this is a brilliant example, a live example, and it probably answers the question that the gentleman there had. How do we guard against this problem? Let us say you had 1 lakh of rupees to invest in. Leaving aside the name of the scheme, you entered at what price, exited at what price. If you put all your money at one go, and if prices fall dramatically after that, you are left with losses. Whereas if you had spread that money out over, let's say, 12 months or 2 years, then you would have bought at 100, you would have bought at 20, and then when it again went up at 30, 40, so you would have averaged it out. Madhu pointed out a lot of people have bought mid caps or small caps and things like that. This, again, I will link it to the analogy of driving a car only looking at the rear view mirror. If the rear view mirror and if the last 100 kilometers have been smooth concrete roads without any potholes, then you will press the accelerator and drive the car at 120 kilometers per hour, and whereas there may be a cliff ahead of you if you don't look out of the windshield. So people look at past returns, select the scheme which has delivered the maximum return in the past year without really knowing the features of that scheme, put all their money in one scheme and at one go without averaging it out. That's where problems arise. See, as an investor, you have, to my mind, 3 to 4 broad avenues as a small investor. If someone has hundreds of crores, then the choice architecture is different. But for a normal person, there are 3 or 4 avenues of investing. One is you can give your money on loan. Now that borrower can be either the bank, which is the bank FD, it can be Government of India, where you buy national savings certificates or PPF or something like that. These kind of loans, or it can be a company, in company fixed deposit, etc. These kind of investments are called debt investments or fixed income investments. That is one avenue. The second avenue is you can own a tiny piece of a business. How can you own a tiny piece of a business? By buying equity shares. If you buy shares in Tata Consultancy Services, TCS, you are partnering with the Tatas in the profits and losses of TCS. Now, sometimes the company may do well, like TCS is doing, or sometimes the company may not do so well, like Tata Motors is doing, for example. So, same business group, right? So, sometimes by owning a business, you participate in the profits. If the company does not do well, your investment suffers. So, first, we saw loaning of money. The second, we saw owning a business. Loan, own, these are the two. Third is real assets, which is you buy an office, give it out on rent, buy a flat, give it out on rent. That's the third opportunity. And the fourth is invest in your own business or in your own profession, or invest in your own education to acquire new skills. So broadly, these 4 aspects are there. Now, every individual will have some combination of these 4 aspects. How much to put in each category? The loaning of money to Government of India is the safest in terms of not losing money. But it also gives you the least amount of returns. So if you are investing money in PPF at 8% per annum, for 100 rupees to double, you will take 9 years. For that 100 to go to 200. On an average, equity in the past, now without getting too much into detail, and one does not know how the future looks like, but on an average, if equity or if some fund gives you 15% per annum, your money will double in 5 years. So 9 years versus 5 years, right? Now, what is the risk of investing in equity or buying shares? Is like, let's say, how do you know whether this company will perform like TCS, or how do you know whether it will perform like Tata Motors? So don't put all your money in one company, buy a lot of businesses. Out of those lot of businesses, some will do very well, some will do not so well. On an average, hopefully you will get a decent return. Also, don't buy at the time of lot of optimism, like we saw. Don't look at the rear view mirror and buy. Buy systematically over the years. Just as an example, you would have heard of something called BSE Sensex or BSE Index. Now this index was somewhere around 100 in 1980. That is whatever, somewhere between 35 and 40,000 of late. 100 to 35, 40,000, right? In these many years, 1980 to 2019. Gold, 1 gram, at that time was also 100. Gold would be between 3 and 4,000 right now, or around 3,000 right now. So 3,000 versus 35,000. That is the kind of difference that equity potentially can make. What is required for equity investment? If you are retired, if you need monthly paycheck, or if you need monthly interest, equity is not the place to be in. You should not buy shares if you are needing regular income. For that, either give loan to the government or to companies, whatever, put in debt securities, or have something like real estate which you can let out, where you get the monthly rental. If you are a 25-year-old today, joining the workforce, if you are planning to retire at age 60, then you have 35 years ahead of you to grow your wealth. Then don't put money in government bonds. Then put a large portion of your money in equities, provided your term life insurance is taken care of, provided you have health care coverage and all of that. Then bulk of your savings should be in equities, because that will potentially double your money in 5 years instead of 9 years. Now, equity is not a guaranteed product. I gave an example. From the same business house, one company is doing very, very well, one company is not doing that well. So there is an element of risk. If you buy a number of companies either directly or through mutual funds, then your risk comes down to that extent.